Over to you, Manish.
Yeah, thank you, Amit. Good evening, everyone. So, transfer pricing, first starting from the transfer pricing provisions. So, the changes in the transfer pricing provisions mainly relate to government intent to rationalize the provisions to bring transparency and just to simplify the provisions. So, first change is in the time limit within which taxpayer has to submit transfer pricing documentation with the officer once the taxpayers receives a notice. So earlier there was a mentioned time limit of 30 days, which could be extended to 60 days, but up to the discretion of transfer pricing officer. But now if taxpayer is receiving a notice, the time limit has been reduced from 30 days to 10 days. So now as an impact, all the taxpayers would have to have the transfer pricing report available, readily available with them, because once you receive a notice, you're going to just get 10 days to submit it. So this will again, this is again a amendment made to rationalize the time limit, so the tax officers could have more time in their hand to complete the assessment. The second change is with respect to the definition of specified domestic transaction. The definition has been widened, and the cooperative societies which have been availing, manufacturing cooperative societies which have been availing the concessional tax rate of under the section 115 BAE, they have also been included in the specified domestic transaction. Now, if any cooperative society is doing any transaction with any other enterprise with close connection, that will come in the purview of transfer pricing. So this amendment is again, this is again has been made to rationalize the provision to just to cover the newly proposed newly proposed cooperative society, to bring them within the definition of 92 BA. Ishu, can you move to the next slide? So yeah, so the third change is with respect to the scope of section 94B. So 94B is about the thin capitalization rules, which puts a restriction on the deductibility of the interest payment made by a company to a non-resident. So if any company is making payment to a non-resident entity, that interest payment has to be restricted to the 30% of the EBITDA. But now, earlier there was some exclusion when this 94B was brought in. It was brought in with pursuance of the BEPS action plan of G20 countries, and which was spearheaded by the OECD. So there was exclusion of banking company and the insurance company because their main business was financing business. But after that, there was a lot of recommendation from the NBFC sector and the professionals, like NBFC should also be excluded, because they are also in the line with banking companies. Their main business is also more of financing. So that's why, just to rationalize this section, the NBFC have also been excluded. So this is again a welcome move to rationalize the provision, which was much needed. And the fourth change is not directly related to transfer pricing, but it is an interesting change which might have a possible transfer pricing implication. So the change is in the section 56 subsection 2 clause 7B, where if any company which is so I'll tell you first about the provision which was there before this amendment. So if any company is issuing shares to any resident company, receiving any shares allotment money from them, so any share proceeds, if the issue price is more than the fair market value of share, that needs to be offered to tax as the income from other source. But now the definition or the scope of the section has been widened. Now that the company is issuing shares to even non-resident entities, if they are receiving any money from them, even that would so the extent the issue price exceeds the fair market value, that is also going to be taxed as income from other source. Now, what is the implication on the transfer pricing provision is that it was a settled principle kind of with couple of rulings. One is in the case of Vodafone India, one is in the case of Shell India, where the Bombay High Court categorically ruled that any issue of shares by Indian company to its multinational parent, that is not subject to transfer pricing provisions, because the transfer pricing provisions are more of a machinery provisions. They are not charging provisions. So this was kind of settled principle, and after 2014, the taxpayers were not receiving any notices when on this transaction of issue of shares. But now with this definition, the government has, seems to have again starting a new chain of litigation, because a lot of notices the taxpayers can expect on this transaction. Because earlier, whenever there used to be any issue of equity shares transaction by Indian company to multinational parent, the professional used to take a stand like, although this qualifies to be international transaction under section 92B, but but this is a capital transaction and it does not impact the profitability. So that's why they used to take a tax neutral stand, and we just used to disclose it out of abundant caution and say like it doesn't impact the profitability, so there is no requirement of any transfer pricing benchmarking. But with this amendment, this definitely going to bring a lot of litigation, and the taxpayers need to be ready with the valuation of the shares to defend to tax officer like these shares are issued at the fair market value. So these were all about the changes in the transfer pricing. Ishu, can you move to the next slide? Yes. So starting with what have been the changes in the litigation regime. So so continuing the tendency from the previous budgets of central government, they have again attempted to bring transparency, bring efficiency in the system, and to just transform the experience of the taxpayers while dealing with the department. So again, they are intended to simplify the tax procedure. So the first change, which is introduction of another first appellate authority, which is very interesting, is very major change. Earlier, whenever a taxpayer used to be aggrieved by the assessment order issued by assessing officer, the first appeal authority used to be CIT appeal. But there have been numerous complaints from even the taxpayers. They have numerous grievances. Like usually the commissioner appeal, there is no specified time limit, and that's why the cases have been pending for long. So taxpayers do not expect the faster resolution at this level. Even the CIT appeal itself a very burdened authority with a lot of pendency in their desk at their desk. So now, just to address those grievances, the central government has proposed to introduce a parallel authority, which will be at the joint commissioner level. That will be called as joint commissioner appeal. That will operate parallelly to commissioner appeal, and the taxpayers can file their appeals simultaneously to joint commissioner. They can either file their appeals with commissioner appeal or with joint commissioner appeal. As of now, it's not clear what is the procedure, what will the protocol, how will they choose whether we need to file it appeal from whether we need to file appeal before commissioner appeal or joint commissioner. But as of now, it has been mentioned like the joint commissioner are going to handle the cases involving small amounts of disputed tax demand. So this will definitely positively impact the taxpayer as well as department. CIT burden of the cases at the CIT level will definitely going to decrease, as well as taxpayers can now expect a faster disposal of their appeal instead of 3-4 years, which is the standard timeline CIT takes to decide the cases. So, coming to the second change in the litigation, which is again a major change. So, the expansion of the scope of appealable orders before ITAT. So, as of now, there are certain orders which can be appealed before the ITAT, but there were certain amendments in section Amendment in Finance Act 2022, whereby some orders CIT was empowered to pass some orders in relation to penalty in case of such unexplained expenditure, undisclosed credit, or false entry or omission of any entry in books of accounts. So, but while these powers were given to CIT to pass order in these cases, but the similar changes were not brought in section 253. So that's why this provision has been rationalized, and now this has been clearly mentioned that these orders can also be appealed before the ITAT. So similarly, the revision order passed under Section 263 by Principal Chief Commissioner and the Principal Commissioner, these persons are, if any order has been passed by these authorities, they can also be appealed before ITAT by taxpayers. So now the third change is again a move to rationalize the provisions. One is that the right of cross objections before ITAT. So what are the cross objection? I would like to just briefly touch upon this topic. So if a taxpayer or the department has filed any appeal before ITAT, so the ITAT gives right to an opposing to the party against which appeal has been filed to submit its arguments as well, which are popularly called as cross objections. But now there was some cases in which the cross objection could not be filed because they were not clearly mentioned in the section in which cross objection power has been given. But now even those cases have been included, and the cross objection can be filed before ITAT in those cases as well. So as of now, if we conclude all those cases in which appeal can be filed, in those cases cross objection can also be filed. So Ishu, can you move to the next slide? So again, this is again a rationalization of time limits for completion of assessment and the reassessment. So there have been multiple time limits introduced in the previous few budgets, and the tax professional, the taxpayers have been quite confused about because the time limits keep on changing. So again, with the final aim to rationalize the time limits under various sections for each and every year. So now the time limit for assessment year 2023 and for subsequent years, the time limit for completion of assessment under 143, which is scrutiny assessment, 154, which is a batch judgment assessment, the time limit has been increased to 12 months. The time limit change is again aimed to provide some breathing space, some bandwidth to the tax officers. So the tax officers have often complaints like they're not able to make proper inquiries, not to ask for the submissions properly because they are left with a very few time, because there is a time limit of 6 months in which they have to issue the notice, and they are left with the 3 months when 9 months was the timeline. But now this has been increased to 12 months. So this will provide some more time to tax officers to make inquiries and focus on the submissions or the replies which the taxpayers make. So this is again a welcome move for the taxpayers as well as the department, because the taxpayers may also expect more judicious, more transparent decision speaking order by the assessing officers. And similarly, in case of updated return, if any updated return has been filed, in those cases as well, the time limit for the completion of assessment is a 12 months from the end of year in which such updated return has been filed. And the next is the time limit to earlier, whenever in section 148, whenever a notice used to be issued by assessing officer for asking the assessee to file the tax return, there was no specified time limit. So there was no uniformity, and every tax officer used to take a different time limit. Some used to ask assessee to submit income tax return within 30 days. Some used to ask to submit within 15 days, some in 1.5 months. So there was no uniformity. So that's why this was calling for unnecessary adjournment and all. So that's why the central government has rationalized this provision by bringing the uniform time limit of 3 months. Now, if you receive a notice under section 148 for reopening the case, you will definitely get 3 months for furnishing your return of income. It is again effective from 1st April 2023. The next change is in for the special audit. So special audit is often called as an inquiry before assessment. If there are some special cases where the books are so complex, accounts are so complex, or the nature of the business of the taxpayer is so complex. So section 142 subsection 2 has a provision for the special audit wherein the tax department can get the accounts of the assessee taxpayer audited from a independent accountant. So that used to give power for the special audit, but there was no provision regarding the valuation of inventory. So now the new power has been given to assessing officer. Now instead of getting the books of accounts audited, they can get the inventory also valued from independent cost accountant. So this is again aimed to prevent assessee from undervaluation of their inventory. Issue, can you move to the next slide? So this is in relation to the cases of search and survey, because sometimes the AO, whenever the AO opens the search proceedings, start the search proceedings after the 15th of November, 15th of March every year. So they are left with very little time to complete or to issue the notice under Section 148. So that's why provision has been added in Section 149, which provides the time limit to issue notice under 148, which says like if any search has been initiated after 15th March of that year. So in order to complete the assessment or in order to issue a notice under Section 148, the time limit, the time of those 15 days shall be excluded. So now the department will have the time of 15 more days to issue a notice, because they can use the information that they have gathered during those such proceedings, and they can make those reasons a part of their notice under 148 to reopen the assessment. So
Manish, I think we need to, we have indirect tax also. So let me just quickly ask you to just shorten it up. So I think for under 132, the main thing is they have asked, they have allowed assessing officers to take help of independent professionals. So you can have computer programmers, like if the tax officers are going on for a search proceedings, let's say in a crypto exchange, being very technical in nature, and to access whether cryptos have gone into a cold wallet or into another exchange, it requires certain technical expertise. So the officers have been allowed now to take other experts along with them in search. Manish, can you just quickly finish the rest, because these are, I think, more procedural.
Sure. So there is extension in the time limit for assessment or reassessment. So if any search has been initiated and the assessment is pending on that date, so the assessing officer or the tax department will get 12 more months to complete the assessment. Issue, can we move to the, yes, so this slide is on the penalty and prosecution. So there has been a change in section 271C and 276B. So the scope of the section has been widened to include reference to the section 194R, 194S, 194BA, which were enacted in the last budget, 2022 budget. Now the penalty can be levied in these cases as well if the deductor has been failed to make sure like the payment has been made of the TDS. Similarly to 276B, it's about the prosecution. Now in this section, prosecution can happen for 194R, 194S and 194B non-compliance. So similarly, there is a second changes in the section 276A, which provides the penalty, which provides a prosecution for the liquidator for the minor offenses, like if they have been failed to issue notices for giving the party, they have been failed to give notice to the parties or setting aside the proceeds of the liquidation. So in those cases, the liquidator cannot be penalized anymore. So that's why the sunset clause has been added, and these provisions are not applicable anymore after 1st April 2023.
Just very quickly, just one thing I wanted to point out. So 194 RS, so these are for virtual digital assets, TDS deduction on virtual digital assets, and one is for perquisites in cash or in kind. So deduction, TDS deduction on that, and then it's for online gaming. For liquidation, it actually now it is all governed by IBC code, and that overrides everything else. And the liquidator is bound by the IBC code. You have a proper waterfall. Tax dues do not get a priority. So therefore, this is no longer relevant. So that is why they have actually put in the sunset clause. Yeah, Manish, next.
So this is again a rationalization provision. So there used to be a lot of controversy about in many instances, the income is disclosed in the return of income in one particular year, but the TDS is deducted when the payment is actually made. So this leads to mismatch of TDS, and taxpayers are not able to claim the TDS credit. But now they can do by making an application to the assessing officer by quoting this fact, and assessing officer will allow the TDS credit if income has been offered to tax in the previous year, but the TDS is being claimed within the 2 years from the end of the year, TDS has been deducted.
And this is very important. It will help a lot of
Yeah.
taxpayers. We had
Right.
Crores and crores of tax demands unnecessarily being pursued because of this. So this is actually really beneficial.
Right. So this is again in relation to
I think it's very procedural. Manish, we can skip this.
Right.
Basically, just means that now the successor company can actually file a modified return of the predecessor, and that's about it. I think it's
More
very,
of a
very
procedure.
Yeah.
Right.
Next.
So I
Okay,
would
great.
like,
So
yeah.
we'll just go through Ikesh. Please, over to you for indirect tax proposal. Sorry, we have taken too much time, Ikesh. Please go on. Thank you.